Here in Spain, we welcome back Chris McCann this week. How are you doing, Chris?
I'm very well, thanks, Howard. It's good to be back.
Yes. Okie dokie. Well, some of our listeners may have experienced investors with a strategic portfolio in place. Others may have just built up their investments randomly over the years, buying shares or funds here and there. Or perhaps they have money sitting in the bank, such as a house sale or an inheritance. So we're going to ask Chris for his advice on how to build a portfolio, a suitable portfolio. So Chris, let's start at the beginning. How should people get started? Whether it's with a new money to invest or taking a fresh look at what they have.
Okay, well, we live in a world where the number of investment choices continues to rise exponentially. Just to give people a bit of perspective, in 2002, there were around 30,000 managed investment products to choose from. But since over the following 2 decades, the number of investment choices has grown exponentially to being currently around 742,000. Today, investors are exposed to more information than any previous generation. Data and research that has only been available to financial professionals is now freely accessible. And this inevitably brings advice and news from sources that might not be qualified to serve your interests. So when it comes to investing, having too much choice will most likely hurt you rather than help you if you don't have proper expert guidance. This being the case, I always strongly recommend seeking specialist financial advice. Having a trusted financial advisor will help you to avoid what I call decision paralysis. And it will ensure that you preserve your wealth and maximize your financial opportunities.
Can you take us through the process with new investment clients? How do you help them establish what will work for them? What sort of things do they need to look at?
In brief, to be able to put an investment plan together, you need to start by having a conversation about your situation and objectives. You need to ask several questions, such as, what stage of life are you at? What assets do you currently own? How much risk are you comfortable taking? What are you trying to achieve? What your current circumstances and future plans are. And only with the answers to questions such as these can we begin to help you navigate the increasingly complex marketplace that exists and build a suitable portfolio.
When providing investment advice, how important is clients' behaviour?
This is a really interesting part of the process. Client behaviour or investor behaviour is key to ensuring that clients achieve higher long-term real-life rates of return than the average investor. This being the case, of the 6 investment principles that we follow, 3 of them are what we call basic attitudinal approaches, which take place in the mind of the investor rather than inside the portfolio. I'm going to go through the 3. The first principle is faith in what we call faith in the future, which, put simply, is the only worldview that squares with the historical record. Optimism or faith in the future is the only realism, or in other words, long-term pessimism is deeply counterintuitive and rarely profitable. I'm yet to meet a pessimist that has made money on a continual basis. The second principle is patience. We live in an age of late-breaking market news, and this places the investor under constant pressure to do something. The more an investor gives into the fads and fears of the moment, the more they lose sight of their long-term financial goals, and the more mistakes they make, and the more their long-term return falls. Finally, the third principle is discipline. Patience dictates a decision not to do something wrong. Discipline, on the other hand, is the decision to keep doing the right things. The undisciplined investor reacts. They allow their long-term investment plans to be derailed by a friend, event, and the plan inevitably fails.
When providing investment advice, you mentioned that you follow 6 investment principles. You've talked about the 3 behavioural principles. What are the other 3 principles?
Yeah, look, the remaining 3 principles are all practices or methods of managing the portfolio. First is asset allocation. The timing and selection culture in which we live maintains that portfolio return is predominantly a function of which investment one owns and when. In actual fact, in the long run, timing and selection have very little to do with portfolio returns. A far greater determinant is asset allocation. Over the course of an investing lifetime, the big swing in portfolio returns comes from what percentage of your holdings are in equities. All you have to do is look at the difference between the long-term return of equities and those of bonds, real assets, and cash to see that it must be the case. The next step is to get broadly diversified or spread your assets. Diversification involves the spreading of risk and reward within an asset class. Disciplined diversification, in its essence, means you'll never own enough of any one thing to make a killing in it, but more importantly, you'll never own enough in any one thing to be killed by it. Third, and the last of these portfolio practices, is rebalancing the portfolio back to the original desired weightings, which typically occurs annually around the same time. It will unfailingly cause the disciplined rebalancer to secure a better return than do the huge preponderance of other investors. Now, taken together, following the 6 principles should ensure that clients earn the returns that they will need to fund their most important lifetime goals, with the minimum expenditure of time, energy, and stress.
Many thanks, Chris. Always interesting. Speak soon. And if any listeners would like to learn more about what we spoke about today, or contact their local Blevins Franks advisor, they can visit your website, blevinsfranks.com.
Thank you, Howard. Speak again soon. Bye for now.